Okay. Good morning, everyone. Welcome to episode 2 of the Climate Investment Lifecycle series, hosted by the Global Climate Finance Center in partnership with the ADGM Academy. It's a pleasure to have you with us again as we continue unpacking how to turn climate finance ambitions into practical and investable outcomes. In episode 1, as you know, we discussed how to unlock capital, and today we build on that by examining the financial structures and instruments needed to support the deployment of capital at scale. We are joined today by a group of experts who will share practical insights, market experience, and lessons on the financial structures that support scalable climate investment. So to guide us through this important discussion, I'm pleased to introduce our speakers and moderator. We have today with us Justin, Managing Director, Head of Climate Change for Asia Pacific at HSBC. We have Melissa, Director in Emerging Market Alternative Credit Team at 91, and Farnham, Senior Advisor at CEO Office at SIF. But before we begin, I would like to thank ADGM Academy for their ongoing partnership in this series. And with that, I will hand over to Rauda from the Academy to offer just a few more welcoming words so we can begin the session. Rauda, over to you.
Thank you so much, Sarah. Assalamu alaikum. Good afternoon or good morning, everyone. On behalf of ADGM Academy, it's my great pleasure to welcome you all to today's episode of the Climate Finance series titled Climate Private Finance from Pipeline to Portfolio, presented in partnership with the Global Center for Climate Finance. At ADGM Academy, we believe that knowledge and collaboration are the cornerstones of meaningful change as the UAE accelerates its role as a global hub for sustainable finance. We see it as our responsibility to convene the right conversations, foster thought leadership, and equip decision makers with the insights to act decisively. Today's discussion could not be more timely as the global challenge before us is clear. We must move beyond isolated projects and create scalable, investable portfolios that can attract private capital at pace. Emerging markets, in particular, stand at the crossroads of opportunity and urgency, mobilizing private equity, deploying blended capital structures, and ensuring the catalytic role of DFIs as anchor investors are essential to unlocking the next frontier of climate finance. As an institution at the heart of Abu Dhabi's knowledge ecosystem, ADGM Academy is proud to support these conversations that drive real-world outcomes. We are equally pleased that this session will also highlight water resilience, an issue that is deeply intertwined with the region's future sustainability and aligned with GCFC's forward-looking mandate. I invite you all to fully engage with today's speakers and take away not just insights, but also actionable ideas that can help shape tomorrow's climate investment landscape. Ladies and gentlemen, together through dialogue and innovation, we can transform pipelines into portfolios and portfolios into impact. Thank you once again for joining us, and we look forward to a productive and inspiring session together.
Thank you so much, Rauda, for your words. So we are good to go and we can start. So Justin, over to you.
Excellent. Thank you so much, Sarah and Rauda, and for the introduction. It's really my pleasure to moderate this session today on a very important topic on climate private finance. I think moderator maybe has a sort of an easier job because I get to ask all the questions that I like. But I'm also joined, by two very distinguished and knowledgeable experts in this area, coming from two sort of related but different perspectives. Maybe I'll just say a few things just to start before we get into the first question. I'll probably turn the first question over to Melissa actually, but just to give you a heads up. So first of all, I just want to say we're very proud to be a founding member of the GCFC and along with our partner at ADGM. Obviously, we feel that this is a very important initiative, given that the idea that how do we catalyze and deploy and also scale private finance into climate outcomes. I think this has been a topic that's been obviously there's been a lot of conversations on it, but I think there's always more that we need to think about and to improve this and to facilitate this conversation. So I'm really happy that we have this series of events to kind of go into this topic in more detail. Secondly, HSBC, we've obviously have also partnered on a number of innovative financing structures to help mobilize private capital towards sustainable growth in emerging markets. Particularly, we've focused a lot on Asia, but now we do want to look at the Middle East. We want to look at other regions as well that really need this. Good example of this has been our partnership with in Pentagreen Capital, with joint venture with Temasek. I'll just mention that because I think that's actually an interesting example of how some of this works as well. So we can dive into that. So enough about that for now. Let's get into the heart of the conversation. Melissa, let me start with you. Maybe just for the benefit of our audience attending this webinar today, if you could just briefly introduce yourself and also talk a little bit about the work you're doing at 921, but also, as a first question, right? What is the problem exactly? What is the problem statement that we're trying to solve, and how do you sort of see this issue? So over to you.
Hi everyone. I'm Melissa Ventura, Director in the Emerging Market Alternative Credit Team at 91. So just some context about 91. It's a global firm, but with emerging market roots. It's an asset management firm with about $190 billion in assets under management, and that's across a range of asset classes. But I would say mostly sort of public equities, multi-asset and fixed income. But within that broader platform, the team that I work in is the Emerging Market Alternative Credit Team, which manages about $7 billion of credit assets, predominantly in private credit and infrastructure finance across emerging markets. And within that team, we have a couple of strategies, but one that I focus on quite closely, that focus on the sort of climate transition. So the fund that I work on is called the Emerging Market Transition Debt Fund, which aims to support sort of issuers across emerging markets that either are transition enablers, so think of like a solar panel manufacturer, etc., or that operate in high emitting but hard to abate sectors, but those issuers sort of have credible decarbonization plans. So really looking to finance sort of businesses that are leaders in the climate transition, but from a very commercial perspective. And then on your question, so I think to sort of emphasize the problem statement and sort of why it's so important to scale private finance into the emerging market climate transition. According to the Climate Policy Initiative, I think in 2023, global climate finance had reached about $1.9 trillion. Of this, only about 200 billion went into emerging economies. So that's only about 10%, which I think is alarmingly low when we think about the fact that about 2/3 of the world's emissions come from emerging markets. 13 of the world's top 20 emitters are emerging economies. And as it stands, emerging markets are sort of on track to constitute about 90% of emissions growth to 2030. At the same time, developing countries are the most vulnerable to the impact of climate change. Emerging market governments often face sort of fiscal constraints, high borrowing costs, competing priorities, which obviously limits their ability to finance the climate transition. And I think estimates suggest that emerging markets will need more than $2 trillion annually through 2030 for climate mitigation and resilience, of which the bulk is going to need to come from the private sector. I think the IMF projects that like 80 to 90% of the finance will need to come from the private sector. And obviously, on the other side of that, you've got institutional investors, so the likes of pension funds, insurers, that are actively seeking stable, impact-oriented opportunities with attractive return profiles. And for these types of investors, especially given their long-term investment horizons, which make them a sort of natural candidate for infrastructure finance, EM or emerging market climate investments can be a very attractive solution. They can offer attractive returns in inefficient and less crowded markets. And considering that these investors manage trillions, tens of trillions globally, if we are able to direct even a small portion of those assets to the emerging market sort of climate transition, that's potentially game changing, right? And it's probably the only realistic path to move from sort of billions to trillions. And I think for us as asset managers, certainly, that's probably the task, right? Is to design vehicles that can connect that institutional capital with sort of commercial emerging market climate solutions.
Thank you for that. Let me bring Farnham into the conversation. I have a couple of follow-up questions for you because so first of all, I fully agree with you. I think we can talk about the gap to emerging markets, right? So clearly, climate finance is not balanced or well distributed at the moment. While the numbers keep going up, $2 trillion or so. China actually takes a large share of that, but actually the really fast emerging markets, whether it's Southeast Asia, across the Middle East, or Africa, Latin America, actually it's really under sort of penetrated, if you will. So I think the idea of having vehicles to do that, I think, is a really obviously interesting aspect that we should explore. But let me bring you into the conversation, because I think you're coming at this from a slightly different angle, but there's obviously a synergy here in terms of where you're coming in and how we can merge that with sort of commercial capital and assets, right? So quick introduction to yourself, please, and also similar question, right? What is the problem statement in terms of filling this gap from your perspective?
Super. Thanks, Justin. So maybe just to introduce a little bit about CIF. So CIF, which is the Children's Investment Fund Foundation, is one of the world's largest philanthropic organizations that's focused on improving the lives of children and adolescents. We have a very broad mission, which spans kind of health, nutrition, education, child protection, and climate, with the aim of driving lasting systemic change in the lives of the most vulnerable. And in trying to achieve that mission, we partner with governments, private sector actors, and multilateral institutions to scale evidence-based solutions and unlock public and private capital. And that's really the focus of my role here at CIF as a senior advisor on catalytic capital. And I'll just echo, before coming to your question, Justin, what everyone said, that we're very proud to be a supporter of the Global Climate Finance Center and the ADGM Academy and the important work that you're all doing. To come to your question, I mean, look, we're, and you touched on this just now, we're talking about sort of climate and water investments in emerging markets. But to be honest, the barriers to scaling in those cases are not that different from most of the challenges to increasing investment in emerging markets more broadly. You've got regulatory and capital constraints, you've got data gaps, you've got bankability, you've got political risk, you've got illiquidity. And as a philanthropy, we are a source of finance that can be structured in blended finance transactions to mitigate those risks. But I think it's really important that we're always clear on the purpose of using that kind of concessional or philanthropic capital, rather than trying to treat it as a panacea for all of those risks and challenges, because it's not the right solution in every context, right? It needs to be used quite judiciously to really support scaling and mobilization. I think sometimes for scaling, the solution actually lies not in financial structuring, but in policy, in the regulatory environment for a given technology. In that case, it doesn't matter how much we grant to a given technology, it's not going to scale up without the right policy signals, right? And when the risk is political, investors might need such a significant amount of concessional finance that really philanthropy is not there a systemic solution either. So we do have different tools at our disposal as a philanthropy to support climate finance. For research and development into new climate solutions, we might use grants or forgivable loans. When we're thinking about scaling up, we can also provide grants for technical assistance and project preparation. But after investment decisions have been taken, we can use debt, equity, guarantees, and insurance to crowd in private investment. And I think where philanthropic capital is being used to scale up and mobilize, there should always be a kind of pathway to commercial deal structuring in terms of risk, return, or duration. So maybe as the project matures, and cash flows are evidence, you might refi a concessional loan through a bank loan. or as philanthropy shows a low default rate, it can become a more attractive proposition for commercial insurance to come in. So I think one of the important things that we should always think about when looking at where does philanthropy play a role in the capital stack when we're looking at scaling up climate finance is, what is the theory of change here in terms of scaling, and build that into the design of a facility so that we are really effectively crowding in private capital.
Farnham, can you give us an example to illustrate that? Because, you know, I think just to be a little bit ignorant on this question, for just pretend, because I know we have a you know, very diverse set of listeners. I think some might be kind of new to this. So, you know, we hear a lot about, okay, philanthropy should come in and sort of catalyze and, you know, and do this. Basically, it's to put it bluntly, it's to do things that, you know, others do not want to do or don't feel that they can. So can you give us an example of what is a good deployment of philanthropic capital to illustrate what you're saying versus what is a mistaken expectation of what it could be doing, what it should be doing?
Yeah, I think, I mean, just to use your words, you know, philanthropy should come in where others don't want to do something. So why don't they want to do something potentially? And often I think what we find is the perception of risk and the real risk, there's a divergence there, right? Especially when we're talking about emerging markets where there might be some of those challenges around sort of data availability and otherwise. And so I think where we have a mismatch of real risk and perceived risk, one of the tools that we think is very effective here is catalytic equity, because that can offer kind of risk-bearing support at that lowest level of the capital stack. So we can deploy that equity that should help us mobilize other people into a given structure. It should help us shape outcomes and incentives, and it should have that possibility for scale. And, you know, we have actually seen that in some cases where we've deployed catalytic equity, we're actually able to recycle that capital. So we see a return on it and we're able to deploy that into other situations.
Okay, thanks. I want to ask you a question about impact and how we measured it, but I'll come back to you in a moment and go back to Melissa. So taking, again, you know, we're talking about vehicles. We were talking about vehicles to scale a moment ago, right? And, you know, from a more commercial, I guess, fund perspective, can you give us some examples of what that looks like as well?
Sure. So, I mean, I think sort of thematic or regional private funds and platforms can offer a lot of advantages when you think about sort of scaling private capital deployment into emerging markets. I think the first is aggregation. So, you know, if you think about a dedicated fund that can bundle a pipeline of uncorrelated projects across sort of countries and sectors with different sponsors and off-takers, you know, that's one way that you can achieve the scale and diversification that the institutional investors that I mentioned earlier are sort of looking for. So instead of trying to attract pension funds or, you know, insurers into a bunch of one-off deals, by allowing them to invest in a fund, you sort of allow institutional investors to deploy the meaningful amounts of capital that they're looking to deploy into target sectors or sort of impact themes across projects that they probably wouldn't have been able to finance or even find directly. And then fund models can also sort of allow replication. So successful models in one market can be sort of adapted and applied to other markets by the same team, which allows that team to sort of leverage key learnings and avoid pitfalls in new markets. And I think that's what a fund manager like 91 is able to do, is we kind of develop and apply consistent approaches to due diligence, ESG integration, risk mitigation across our funds, which then builds investor confidence that these opportunities are being evaluated against proven sort of frameworks. And then we obviously also look to structure these funds in a way that mitigates the perceived or actual risk in the markets that we invest in. So one of the tools that I think Farnham touched on is blended finance, which is often used to sort of dramatically de-risk portfolios and crowd in private capital. So for example, many climate funds would use sort of a layered capital stack, right? With junior or first loss tranches coming in. And those are often funded by governments, DFIs, or concessional investors, which can enhance the sort of credit quality of the more senior tranches, making them suitable for institutional investors with sort of lower risk appetite. And all of that is over and above sort of careful structuring at the actual underlying deal level. So if I think about the case of private credit, which is obviously sort of what I focus on, we would look to support strong sponsors, negotiate very robust commercial and legal protections, get robust security cover at the underlying deal level. And in some cases, we would use guarantees from sort of creditworthy institutions to sort of improve the bankability of transactions that we think would otherwise be too risky. And then if you kind of think about putting those all together in a private credit fund, which has a diversified portfolio of these mostly senior secured, well-structured loans, each backed by sort of equity and subordinated capital at the project or company level, and then kind of adding a, let's call it 10 to 15% junior layer at the fund level, you can see how the overall portfolio risk can be quite significantly reduced, even if you're investing in newer technologies or investing in emerging markets that would otherwise be a little bit daunting to the institutional investors that we're looking to attract. And so I think that's kind of, articulates how we can build funds where risks are very well managed. The highest risk is sort of allocated to those best able to bear it, while private institutional investors can get stable, attractive returns and often outsized returns for the level of risk that they're actually taking when you kind of think about all the mitigants. And I have a couple of examples of funds managed by 91 that I think have achieved this quite well, but we can maybe touch on that at a later stage.
Well, actually, I was just about to ask you that to have an example to illustrate the funds, right? So one is to illustrate, okay, so what kind of funds are these, and what are they targeting? And when you say, look, I mean, we were talking about emerging market risk or technology risk. I think it might be helpful for our audience, maybe either you or Farnham, I think, can illustrate like what do we mean by that actually, right? What is an example perhaps of a project or a market where there is some kind of risk that would make it sort of not palatable, to a typical, let's say, commercial investor, but might be fine for, let's say, blended finance or something else like that, right? So.
So, I mean, one example of a fund that 91 manages is the Emerging Africa and Asia Infrastructure Fund. So this is a blended finance vehicle that uses sort of a mix of catalytic equity from 6 governments. So it's the UK, Netherlands, Switzerland, Sweden, Canada, and Australia. And that equity kind of comes in from a vehicle called the Private Infrastructure Development Group. And then that equity has been levered up with sort of debt capital from DFIs and then commercial banks in sort of a layered capital stack. And it's used to deploy into infrastructure projects across sub-Saharan Africa and parts of Asia. And this fund targets the sort of least developed countries, in most cases being frontier markets. It only does sort of new capex, so it doesn't sort of do refinancing of any previous loans. So it's always going to be new capex. It's often like new technologies. It's often in very fragile and conflict-affected states. And yet to date, since I think 2002 when the fund was launched, it's achieved a loss rate of less than 15 basis points per annum. And this fund has earned an investment grade single A rating from Moody's. So I think if you think about like a fund that's investing in new technologies, in frontier markets, often very difficult markets to invest in otherwise, it's quite impressive that it's managed to achieve an investment grade rating and a very low loss rate. And by leveraging sort of the catalytic government funding with DFI and commercial bank debt, and then also recycling capital as it gets returned to the fund, the fund's been able to commit, I think, more than $3 billion across more than 130 transactions in like I said, the sort of riskiest parts of Africa and Asia, while earning a sort of gross IRR of like 9% in dollars. And the amount that's actually been deployed is more than 8 times the actual capital invested. So I think that fund is quite a good example of sort of how blended finance structures can transform risk and sort of catalyze private investment, whilst also generating sort of attractive commercial returns and achieving meaningful impact.
I might jump in.
Yes. Please go
I was
for
just
it.
going to jump
Yes.
in to give an example on our side. One of the grantees that we've supported is Allied Climate Partners, which is a philanthropic organization that anchors blended finance funds in emerging markets. And they're focused on specific gaps in each case of the shortage of development stage equity and bankability of projects and businesses. Basically, you can think of them as an LP that takes first loss downside, but pari passu upside. And we've been really delighted that ACP has managed to anchor investments into Southeast Asia, Africa, and the Caribbean, all focused on that problem of the lack of late stage equity for bankable projects and platforms. One fund, which is a fund focused on Southeast Asia, which was anchored back in 2023 with 15 million of junior equity from ACP. They were able to crowd in an additional sort of 30 million in first loss capital from other family offices and nonprofits. And that sort of 45 million tranche of junior equity then crowded in about 130 million of senior equity to be raised from a number of institutional investors. So that's basically an 11x month multiplier at the fund level, which is fantastic. I think, you know, in addition to the funds that Melissa mentioned, we've also seen this kind of catalytic equity from the IFC, which now has a kind of frontier opportunities fund, which is targeting about 500 million of catalytic equity. BII, the UK DFI, has a 100 million mobilization facility where it partners with Mercer's. And we've just seen also in Singapore, the FAST-P program, which is effectively a matching program for catalytic equity. So the government of Singapore having made about 500 million of catalytic equity available, which can be unlocked on a one-to-one basis, with other providers of catalytic equity. So I think, you know, this model does seem to be replicable in different contexts, both for the scaling up of kind of technologies and also for the mobilization into emerging markets.
Thanks, Farnham. Actually, that was exactly the question I was about to ask you about the example. Let me go out a little bit on a limb and say that let's pretend for a moment that Melissa, Farnham, you two are in a room and you decide to set up a new fund, right? You know this question is coming because, you know, I think that there's a natural partnership opportunity there. So maybe I'll break it down into two or three questions on that. So let's say you're in a room and you have an idea to set up a new fund, and we're all sort of, you know, witnesses and privy to that. I mean, usually that doesn't happen in real life, but let's just pretend. So question one, who else would you want to invite into the room for that conversation to set up the fund? Question two, what would this fund do? What gap would it fill? And, you know, what would it do, right? Essentially, what do you think is still missing in terms of, in terms of things that we need to do? And then third, maybe slightly self-interested, would you invite me from a commercial bank into the room, and what role would we play if you did? So Farnham, you want to go first? You can address any of those three questions in any order you like.
I mean, I can see on the chat, there's been a question about why the Middle East receives only 6.6% of global climate funds, despite the vulnerability to climate impacts. So maybe I'll take a bit of a dodge on that one and say for the second answer, you know, I think there's obviously a need to have some of this blended finance in the Middle East as well. And I think from our perspective, we'd be looking to certainly crowd in commercial banks, because I think one of the most powerful roles that commercial banks play is in distribution, right? Is in the relationships that they have and their ability to distribute loans. So if we can bring in concessional finance or, you know, even guarantees from the likes of either a sovereign or a development agency to help mitigate the risks that a commercial bank like HSBC might see in lending for climate adaptation and mitigation purposes, then I think a commercial bank is actually one of the best players to be able to do that lending.
Yeah, I mean, just to add on to that, I think, you know, between the DFI world, commercial banks and asset managers, we all sort of have quite a different but complementary role to play. You know, the DFIs or foundations, for example, can provide the first loss equity, the guarantees, etc. Often also technical assistance and capacity building and assistance with project preparation, all of that. Then, you know, commercial banks, I think, as Farna mentioned, in terms of the relationships and the ability to sort of originate and syndicate loans, and particularly with banking regulations and sort of capital requirements, etc., often not wanting to take and hold all of the exposures that they originate. But then also being able to provide revolving credit facilities, for example, and things that us as asset managers are not really well suited to doing. And then, so we see ourselves very much as a partner to commercial banks, where we can provide sort of long tenors. We can kind of allow banks to recycle their capital by originating and then syndicating whilst maintaining the relationship with the sponsors. So yeah, I think there's a sort of complementary role to be played amongst all of these players.
Great, thank you. Actually, it wasn't only about commercial banks, but also where, whether either you felt like there was others you might want to bring into the room, let's say, to build a new fund. But yeah, of course, I would fully agree with you on the role of commercial banks in this, and in terms of what we can play on this. Okay, look, it's been a fantastic conversation. I can't seem to see the questions on the chat, but I feel like I don't know if you two can, but I feel like we may have some, and we want to definitely take some questions from the audience on this one. So do we have any questions from the audience that we can maybe take for a little bit? Otherwise, I will ask some more questions.
Maybe I'm the only one who can see the questions, but I can see them.
Okay.
And there are a few.
So,
yeah, maybe I'll take over moderating.
Okay, yeah, please. So read a few you think we should answer, and let's take it from there. Yeah.
So there's a question around, I sort of touched on one of the questions, which was why the Middle East is receiving only 6.6% of global climate funds. And also, it was part of that question, how could application processes for funds like the Green Climate Fund be simplified to improve access for conflict affected or low capacity countries? There's a question about how meaningful and realistic debt for nature swaps are as a mechanism to address climate challenges. Someone's asked a slightly wonky question around which blending structure is preferred, blending at the fund level or the project level. And I can also see a question around how could the finance civil society get involved in the fight against climate challenges at local level, as well as how can we scale de-risking solutions for climate projects.
Do you want to have a stab at the first question, actually, about the how to apply for why the Middle East is underpenetrated and how do we apply for climate funds?
Yeah, I think this is a really important question, because one of the things that I have been looking at more recently is sort of the market knowledge and understanding of the funds that are available to them. I think the Green Climate Fund is relatively well known, and the application process, as alluded to in this question, is complex. That is because of the structure of the fund being effectively a sovereign managed fund, right? It has a lot of political players around the table. But actually, GFANZ is doing some work right now. The Glasgow Financial Alliance for Net Zero is doing some work right now on blended finance. And one of the interesting findings from that work has been around how much there is now by way of funds for technical assistance and project preparation in particular. Over 130 different project preparation facilities are available around, for climate financing. And I think this is something that is kind of a market education and knowledge problem more than it is an availability of funds problem.
Yeah, I think that GFANZ example you highlighted is actually really, really interesting. So there are resources out there actually to help essentially do some of the upfront, I guess you can call it an upfront cost or investment, right? Necessary for projects to sort of get to the stage where they can actually be essentially, investable, right? I think that's something that actually probably should be highlighted a bit more, because you're right. I don't think that actually is well known what kind of resources are actually out there to support people with ideas for some of these early stage projects that may not be affiliated with large sort of organizations or institutions. Melissa, any of those you want to maybe take. The question about the blending structure. I don't know if you want to get into that one. That's quite a technical one, actually. Or the other one about the debt for nature swaps.
Sure. I mean, we've seen some examples of debt for nature swaps sort of working quite successfully. So I think both the Seychelles and Belize have in the past generated capital for sort of coastal resilience, often less for mitigation purposes and more for adaptation, where there isn't a direct revenue stream, and so you need to really think creatively about how to sort of structure transactions that are bankable without necessarily generating like a direct revenue stream with which to either provide a return to equity or pay back debt. And so I think both of those were facilitated by the Nature Conservancy. But what I will say is that we haven't really seen these come to the market at scale in a way that is as replicable as like green bonds, for example, where there are quite well understood frameworks that investors have gotten quite comfortable with over time. So, I've seen these more as sort of isolated transactions. And we actually, in the funds that I work on, haven't invested in any of these. Also because, by the time that it's sufficiently de-risked, often the return is then quite low. And so, I think there have been isolated examples where it's sort of worked, but, I think a lot of work still needs to be done for it to be sort of rolled out at scale, I would say.
I wonder if you have a view about, on the question of investors, right? So there are obviously impact investors out there with a slightly different way of viewing this. Is that something that you feel that, that could be, for instance, brought to bear on some of these examples, whether it's adaptation projects, or actually, at the headline, we talked about water, right? Which is also I think it's also often difficult to monetize, if you will, right, in the traditional way. Any view about that in terms of the type of investors that you engage for your funds? Would you look at impact investing, for example, investors?
Yeah, so I mean, most of the funds that we manage are sort of institutional investors, although we do have some sort of foundations and more impact-focused investors that come in. But typically,
I think we lost.
Okay. Typically, when they're coming to sort of a 91 fund, they're looking for more commercial sort of returns, etc. But of course, in other contexts, impact investors or more philanthropic capital is able to play a role in either, taking on the early risk in projects, etc. that a 91 wouldn't necessarily come into, or in creating like blended finance structures, etc., where they provide the first loss capital. And maybe to touch on one of the other questions, whether it should be done at the transaction or the fund level. I mean, I think we see examples of both. So, we often invest in sort of securitization type models where, a bunch of individual assets are bundled into a SPV structure where there's sort of first loss capital, and we might invest in the sort of more senior notes, and even those are then tranched for an investor like 91 that maybe is able to take a little bit more risk than an insurance company or a bank. And so then, we can kind of all invest in different tranches in that capital structure. And that's then done at the transaction level. We think of that as a transaction that we would invest in. And then similarly, as I mentioned, like the Emerging Africa and Asia Infrastructure Fund, for example, uses blended finance at the fund level to attract commercial bank debt, for example, into its capital structure. And so I think the two, again, need to sort of coexist, and each has a role to play. And we also see in some cases with like project finance type transactions where, the equity is provided by somebody with more of an impact lens and with higher risk tolerance. And then, an institutional fund like 91 would come into the sort of senior debt. Yeah.
Okay. Thank you. Farhan, do we have any, since you have access to the questions, do we have any other questions? I think we're coming up close to time, but we may be able to take one or two more if there's some interesting ones out there.
There's a question about AI, which I think is really always very relevant, given how primary that topic is these days. So how are you all using AI in understanding of climate and economic uncertainties, both in investment and capital allocation decisions?
That's a big question.
I think where I've seen it
Yeah.
be really exciting is on physical risk, where I think the modeling through the use of AI has just really improved our ability to think about resilient strategies, the return on those investments, and that's been, I think, the most effective use of AI that I've seen in kind of thinking about investment decisions and capital allocation decisions.
I think, yeah, I mean, I'm just thinking because there's so many ways to answer this question. And you know, every day, I have to be honest, you know, I come across different pitches on AI solutions that, you know, can help, right? But a few, I mean, they could almost be grouped in sort of thematic ways in terms of what people are using it for. But some interesting things I've seen, for instance, are AI to help actually monitor outcomes, right? Big data, using that to kind of monitor outcomes, whether it's on transactions or deals or other things. I think in the real economy, there's a lot of work that companies are now doing about how to utilize AI to manage, you know, infrastructure, power systems, data centers to make them more efficient, even though they use data. AI itself uses data centers. And there are studies out there. I don't remember all the numbers on the top of my head now, but there are studies out there about actually because often people say, well, AI is going to lead to massive demand for energy, but actually there's a benefit as well that they can improve and increase efficiency, help us actually manage a very complicated power system that's increasingly decentralized and using renewable sources, for et cetera, right? So I think we're actually really at the beginning of all these sort of potential applications, and I think there's a lot more potential upside than simply just saying, well, okay, it's just going to consume a lot of energy, but actually the application could actually provide a net benefit, I think, for us. But maybe that's an open call to everybody to say, look, we welcome new ideas. I think particularly from investors, maybe more than for banks, but I think we would welcome ideas utilizing AI, right? To see if there's any solutions out there we can utilize. Melissa, I wonder, if you have a view about it. I think this question comes up in every panel that we sit on these days. Yeah.
I mean, not much to add other than, maybe highlighting how we are also investing in sort of making data centers and sort of AI more sort of sustainable. So we've actually invested in a couple of data center projects where they are fully powered by renewable energy with sort of very low, PUEs, which is obviously the metric we use to look at the energy intensity of data centers. And I think we've actually recently just done a transaction with the first data center operator in Latin America to have achieved complete sort of net zero carbon emissions across all scopes. And that's through sort of using renewable energy, operating on a very water efficient basis. And then also, I think they've defeased the remaining carbon emissions using sort of carbon credits, etc. So I think we are starting to see like industry leaders emerge there, which is quite, it's the flip side almost of the question. But yeah, so.
Great. I think we're coming up to time, so maybe I'll hand it back to our host for the podcast. But first, I just want to really thank Farnham and Melissa. It's a really fascinating conversation, and I think it hopefully gives everybody some ideas about how we can work together. So really looking forward to further discussion and also brainstorming and potentially collaboration in these areas. So thanks very much. Back to you, Sarah.
Yeah, thank you so much, Justin, Melissa, and Farnham. I'm sure that we would all like to keep going, but we need to be conscious of time. So thank you again for the highly practical discussion today, and to everyone in the audience for joining us and sharing your questions. So today's session offered a detailed look at the structural considerations involved in scaling climate finance, including pipeline aggregation and fund architecture. So these are critical components of how capital is mobilized and deployed in practice. And this concludes our episode 2 for the series. Just for your information, since I've noticed few questions were on climate tech, startup, and AI, in episode 3, we will shift focus to the very beginning of the pipeline. So we will look at climate innovation, VC, and the condition needed to position early stage solution for investment. And before you leave, a reminder that participants who attend all 3 episodes will receive a certificate of participation from ADGM Academy. So thank you again for joining. A special thanks to our amazing speakers. And we look forward to continuing the conversation in episode 3, which will be, as already mentioned, our next and last episode of the series. Thank you so much again.
Thank you.
Thank you,
Thanks, everyone.
Thank
Have
you,
a great
guys.
day.
Bye-bye.
You too.